And from that agenda, we have two key areas to be able to look at. We have the issue of capital budgeting techniques and also capital markets, which is also some areas of interest in procurement, supply chain management costs, which we need to be able to focus on. So now we want to start with the first thing, which is capital budgeting techniques. And we want to look at some of the investment decisions that organizations are able to make over certain capital investments that they actually make in an organization, which is a crucial factor of consideration in the procurement of an organization. It is always good to be able to look at some of these capital budgeting techniques as much as possible, and that's why we want to be able to look at that. So one of the things we want to start by saying is that capital investment decisions of an organization in a project are generally known as capital budgeting, or what we call capital expenditure decisions. So when you talk about capital decision, it means we are simply talking about the capital investment decisions that are done by an organization, and simply that's what we call capital budgeting or capital expenditure decisions. The decisions that can actually be defined as the organizational decisions to invest its funds in long-term assets with an expectation of flow of benefits over a series of years is what we are referring as capital budgeting. And it's a very important consideration in most organizations because most organizations want to be able to identify exactly how some of these things will actually be financed in an organization. And so anytime you think about capital budgeting, we are thinking about some long-term projects that will involve some capital investments, and we need to make sure that we are actually able to fund some of those capital assets, and it's important to be able to look at that. So again, also the other thing is the some of the decisions are normally difficult to make, and once they are made, they actually become irreversible or reversible at substantial loss. And so some of these decisions really became very, very difficult to make, and once they are actually made, they actually become irreversible or reversible at substantial loss. And so it is important to make sure that we are actually able to consider some of those decisions. And the other thing is this is because they will involve the commitment of large amount of funds, which simply affect the risk of the organization and will influence the firm's growth in the long run. So it is important to make sure that the commitment of this large amount of funds affect the risk of the organization and actually influence the firm's growth in the long run as much as possible. So it is important to consider that we can actually be able to have some of these commitment of large funds as much as possible. And so the choice of investments for projects can actually be classified as follows. There's what we call mutually exclusive investments. And so sometimes you might want to be able to invest in two projects, but one serves the same purpose as the other. So if one of them is selected, then you will actually do not have the need to continue with the other investment. And so that's what we normally refer to as mutually exclusive events, and they're very, very important to be able to consider. And so mutually exclusive investments, normally these are investments that basically serve the same purpose and compete with one another. So if you undertake one investment, then the other investments will have to be excluded as much as possible. So that's what we refer as mutually exclusive investment. The next thing is also consideration of independent investments. And so it is important to see whether you can actually be able to consider independent investments. And these are basically investments that actually serve different purposes and do not compete with each other. And it is important that depending on profitability and availability of funds, a firm can actually undertake all the considered investments as much as possible. So that's what we refer as independent investments. Then thirdly, we have what we normally refer to as contingent investments. And when you talk about contingent investments, these are simply dependent projects. And simply what this means is that the choice of one investment will actually necessitate undertaking one or more other investments. These ones happen in such a way that if you consider one investment, then definitely you can't do away with the other one. They definitely go together alongside, and so they have that contingency dependency, and it's important to actually be able to understand them as contingent investment. And then the other thing is also looking at the concept of project cash flow, because besides being able to invest in a particular capital project, the other thing is also the consideration of the project cash flows. The moment you invest in a project, I think it is also good to make sure that you are actually also to project the kind of cash flows that you can actually be able to make from the different kinds of investments. So we're saying that cash flow basically deals with the whole life of the project, not just the implementation period only. And it is important to see how we can actually be able to deal with that, the issue of the implementation period only. And again, also at the early stage of the project will actually experience negative cash flow, as there is no income in these particular stages. And so in the operation stage, the revenues will continue to increase than the expenses. And so the revenues will continue to increase than the expenses. When comparing the economics of projects, the cumulative cash flow provide indicators for such comparison, such as payback period and profit. Then these indicators are normally called the profitability indicators. And so these indicators are basically what we normally refer as profitability indicators. And maybe before we look at the profitability indicators, let's just be able to look at this, what we call a typical cash flow project. So what normally happens when you're considering to procure and implement a new project, one of the things that you will find is that during the beginning of the project, cash flows actually dip because we do not have any revenues that we make from the project apart from the investment that we have for the project, and that's why it takes a dip and starts rising at some point as soon as the project starts to make some operation. So it is able actually to rise and continue until it gets to a certain point where it actually comes to an end. And this is what we are referring to as payback period. That is basically the period that we use to actually be able to pay back the project, or actually the cash flows actually equal the initial investment of the project. And that's what we call the payback period. So the other thing is the fact that the project profitability indicators, there are several components in the project profitability indicators, and one of it is what we are calling profit. This is the difference between the total payments and the total revenue without the effect of time on the value of money. And so when comparing alternatives, the project with the maximum profit is actually ranked the best. And then secondly is the issue of payback period, which is the length of time that it actually takes for a capital budgeting project to recover its initial cost, and where the summation of both cash out and cash in equals zero. And so when comparing alternatives, the project with the shortest payback period is ranked the best. And so having looked at that, I think now we can look at the specifics of certain capital budgeting, and so the value of money is therefore dependent on the time at which it was received. So that